instantly save 50% on your taxes. There are legal ways to avoid taxes. First time I heard it, I also couldn't believe it. Unbelievable money tricks and hacks. The entire $1 million is yours, completely tax-free. What's up, investors? It's the Russian dude, and today I will teach you how you can instantly save 50% on your taxes. And by the way, did you know that less than 1% of tax returns are audited, and still more than half of Canadians are still doing their tax returns with professionals, which means that people still do not trust themselves with their own tax returns. That's it, my very first video about taxes, which means that now I'm certified personal finance YouTuber. But whoa, it doesn't mean that I'm certified accountant, so please feel free to talk with your tax professional, because all the information that is presented in this video is only for educational purposes. Okay, so just like the USSR, before it engaged the USA in the Cold War, taxes are very boring. But I'll try to make it as informative and entertaining as possible, because every single person loves to save money. And because filing your very own taxes is extremely easy. Just if you have a regular 9-to-5 job and maybe do some occasional investing, you definitely can do it. So the tax document that you receive from your employer is called T4, which shows how much money you've made and how much are your contributions. And one which you receive from your online broker, if you have any, it's called T5008, and it shows you any investments that you've made. These are primarily two main tax documents that you might need in order to file your own tax return, but in some cases there might be more. But no worries, most of the documents that you will receive will tell you exactly how much money you need to put in exactly which places on your tax return. So T4 that you receive from your employer is pretty basic, and there's almost nothing you can do about reducing your taxes. But if you had any capital gains or capital losses during the year, this is exactly what you need to do in order to reduce your taxable income. But first of all, literally 15-20 seconds of theory. So first of all, capital gains tax is triggered when you sell something for higher than you bought it for. For example, you bought one share of XYZ for $100 and you sold it for $130. And this $30 is subject to capital gains tax. But if you sell the same share for $80, this $20 is your capital loss. Capital gains and losses can be realized or unrealized. If shares inside your portfolio go up and down in value but you do not sell them, this means that this is an unrealized capital gain or capital loss. But as soon as you sell them, this is when these losses or gains are realized. And the only time when this affects your taxes is when you have realized capital gains or capital losses. 15-20 seconds of theory. The first advantage of capital gains in Canada is that only 50% of this entire capital that you received is taxable. So let's say you filled your entire portfolio with brand new shares worth of $10,000, and later you decided to sell them and you received $16,000, which means that you've made $6,000, and from this only 50% is taxed, which means that only $3,000 is added to your taxable income. First time I heard it, I also couldn't believe it. How is it possible that 50% of your gains in Canada is completely tax-free? And if you want to receive more unbelievable money tricks and hacks, feel free to like this video and subscribe to my channel. So, like mentioned previously, this $3,000 is added to your taxable income, and then you're simply taxed in accordance with your tax bracket, which depends on how much money you make. So this is what this means. If, for example, you have $50,000 in taxable income, and then you have this $3,000 in capital gains, your new taxable income is $53,000. But the real fun starts with capital losses. And I know that not a single person likes to lose money unless you are an investor in GameStop.
Please send help.
So what you can do about this is that you can use your capital losses to offset some of your capital gains. Let's say you have the same $3,000 in capital gains, but because you did some unfortunate trades with the GameStop, you lost $2,000. So you can use these $2,000 to offset $3,000 of capital gains, which means only $1,000 will be added to your taxable income. And by the way, capital losses and capital gains are not applicable just for stocks. This concept can also be applied to real estate investing, mutual funds, ETFs, or literally any other trade if it is properly documented. So make sure you keep all the paperwork for every big transaction that you ever made. You can put them all in the drawer with all the other thousands of papers that you're never gonna use in your life. So, and after claiming capital losses, you can repurchase the stocks that you sold earlier, which is also known as tax loss harvesting. But you cannot do it within just 1 month of the sale, which is known as the superficial loss in Canada or wash sale rule in the USA. But if you don't want ever to pay taxes, you can go to jail.
Right to jail, right away.
But seriously, there are legal ways to avoid taxes. First of all, you can open the TFSA, which is tax-free savings account. And every single dollar that you gain, dividends, distributions, or anything else that happens inside your TFSA is completely tax-free. So let's say if one day your portfolio reaches $1 million inside TFSA, obviously, the entire $1 million is yours.
It's not a liquid!
And the only restriction there is to it is that there is an annual contribution limit for the TFSA, and in 2022 this limit is $6,000 per year. And if you want to open your very own TFSA and enjoy all this tax-free growth, you don't need to go to the bank. You can simply use the link in the description, and if you do so, you can receive free shares, valued all the way up to $4,500. Am I too high? Do I need to go down? Okay, much better. Another option is to open an RRSP, which is Registered Retirement Savings Plan. So you can open your very own RRSP with your employer, or you can do it yourself. Extremely easy. So the thing about the RRSP is that all contributions that you made are from pre-tax money, and all the future growth that you'll experience inside your RRSP portfolio is also completely tax-free. Besides this extremely cool 2 features, believe it or not, there is one more.
Oh my.
Contributions that you make for your RRSP also lower your taxable income. So let's say if your taxable income is $50,000 and you contributed $5,000 inside your RRSP, your new taxable income will be only $45,000. And just like with the TFSA, there are annual contribution limits for the RRSP, and in 2022 the contribution limit is $29,210. And the only time you will need to pay taxes for your RRSP portfolio is when you withdraw money, which is assumed that you will do when you retire, and your taxable bracket will be way lower. It is also, by the way, worth mentioning that you cannot use capital losses that happen inside your TFSA or RRSP. Tax loss harvesting is only allowed outside tax advantaged accounts, but at least Canada allows you to carry forward all the unused capital losses indefinitely, or you can use them 3 years back if you want to amend any of your previous tax returns.
Yeah, boy.
And don't worry, all this might sound like so much paperwork, but your broker got you covered. Average cost basis, capital gains, capital losses, all this is tracked, summarized and recorded by your broker, and then he sends you the paperwork. And all you need to do is just to receive all these documents and then file your very own T1 General Income Tax form. Thank you for your attention, товарищи. I will see you once again on Friday, and all the useful links will be down in the description. And by the way, if you want to learn more about capital gains, capital losses, or any other fancy tax words I've been using in this video, the suggested video will appear right now.